Dividends are absolutely useless. I mean, who would ever want to just get paid for owning great businesses? No, seriously, consistent income sounds disgusting and a terrible thing. I would much rather depend entirely on market moods on when I decide to sell. Matter of fact, let's step into the echo chamber of Reddit and witness why dividends are apparently trash over on the Financial Independence Retire Early subreddit. So about a week ago, I came across this thread. It says, hey, living off dividends, what's the withdrawal rate? I'm 50 years old, I just retired recently. If my portfolio throws off enough cash to cover my expenses, would the dividends be considered my withdrawal rate? Or is it 0% because I'm not touching the principal? Basically, in the Financial Independence Retire Early community, the withdrawal rate is the specific percentage of your portfolio that you sell per year in order to create a synthetic dividend. And by scrolling down and looking at the comments, I'm not exaggerating when I say my hairline receded by half an inch by how delusional some of these people are. This one is coherent, makes sense. This one right here, it doesn't matter if the cash comes from dividends or coupons or selling stock. This notion of touching your principal is typical dividend gang brainwashed behavior. It does not matter at all. So what I'm going to do is I'm going to read these comments, and then I'll be responding to each of the comments because I think it's better if we take a look at all of this in aggregate and as a whole first. You don't live off dividends, you live off the total return. Use total market indexes. Dividends are still money being taken out of your portfolio. There is no difference between a dividend and selling shares. 88 people agreed with this comment. That just boggles my mind. Except that dividends are typically worse for taxes. Oh my goodness gracious, the amount of misinformation just being spewed around. Yeah, it almost gives you a migraine, doesn't it? Dividends are forced automated selling. They're very nice psychologically as it's all automated. You don't have to sell any shares. They're just worth less. And it feels like free money, but under the hood, it's just a withdrawal, and it's taxed as income, while selling shares is capital gain or loss. So in the end, all that matters is total return. Goodness gracious. And then take a look at this comment right here. Dividends are the same as a forced sell of a stock. There is no free lunch. When dividends are paid by the company, they have decreasing assets, which is the cash, equal to the amount paid. So basically, you are selling equity and getting a cash distribution. Dividends are completely psychological withdrawals. It's not magic or free money. The share price decreases every time you get a dividend. And when the market tanks, dividends can and do get cut. Between you and me, I should have given you guys a trigger warning before I went through that thread. Because I'm not even trying to be hostile or mean here, but the lukewarm IQ of the people that are commenting there is just, that's what I'm saying. With the internet, you never know who the heck is on the other side of that screen, right? And so many people on there are agreeing with one another that dividends are useless, that dividends are a scam. So now what's going to happen is systematically, let's go ahead and address and rebuttal the bigger speaking points about why dividends are stupid. So claim number one, you don't live off dividends, you live off total return. All right, buddy, first of all, there's not a single dividend growth investor that rejects total return as being important. The CAGR, yes, all of us agree as investors, that's what makes our portfolio and the money that we can make potentially very important. However, what I'm trying to say is when you need to create cash flow to pay for stuff in real life, such as your mortgage, your utility bills, your cell phone, internet, your OnlyFans, subscriptions, whatever it is, it boils down to two options when we're talking about our brokerage accounts. Passive income versus active selling in order to generate that synthetic income. Listen, please pay attention. If you sell your shares during a market downturn or bear market, you sell your stocks, your equities, your ETFs, whatever in question, at lower prices. Whereas with dividends, even during red days, you get dividends and you're not forced to sell at an unfavorable price, right? And don't get me started on dividends not being guaranteed. When 85% of companies sustained and or grew their dividends during the pandemic, when you would think that every company around the world would have been cutting their dividends. That is not the case. McKinsey did a study and it showed us that 85% of the companies grew their freaking dividend in 2020, 2021. So when people like to keep screaming in my face saying, oh, dividends can get cut any second, it's like, shut up. Yes, the companies that had shaky financials heading into a catastrophic event, yes, those dividends are going to be cut. But when we talk about Nvidia, Microsoft, Coca-Cola, United Health, Huntington Ingalls, high-quality dividend compounders with cheese, those dividends are not going to be cut. Do you hear me? And besides, if you're going to be intellectually honest, total return is backward looking. And with share price appreciation, you cannot. And if anyone claims they can, they're a fraud, they're a liar, and they probably have small feet. Nobody can predict what will happen 9 months from now, let alone 2 weeks, right? So how are you going to bake in that your portfolio is hypothetically going to grow by 10%, right? Whereas with dividends, you can predict and plan your salary, your passive income, your cash flow based on the dividend growth rate and the dividend schedule that gets declared annually. A publicly traded company, and remember, we're only talking about the high-quality compounders like Fastenal, like Hess Midstream, or even Cisco, they'll tell you upfront 365 days ahead of time, hey, here's how much we plan on paying in dividends for this year and how much we're increasing it from the previous year. And I don't know about you, but in retirement, as a passive income-oriented guy, that sounds a whole heck of a lot better to me than having to try to predict when to sell when the market conditions are optimal, and when I plan on selling shares, the market needs to cooperate with my retirement game plan. Who is to say that the external conditions and variables will be perfect and sunny with rainbows when I plan to sell? No, anything can happen. Another Venezuela crisis, Iran situation, anything can happen. The market will not cooperate with your game plan when you plan to sell. That's why if I just sit back and allow the passive income to pour in for my high-quality dividend compounders, I'm a happy camper. I keep saying high quality because I already know for a fact we're going to get some fat lard comment in the comments section talking about, oh, but what about this? What about that? They're going to be pointing out outlier examples of low-quality cigar butt, crappy financial possessing companies, and that's not who I'm talking about. I would never invest into a hairy, ugly, sticky, smelly business. I'm going to be completely transparent with you. I just feel my blood pressure getting up there. The absurd amount of stupidity on the internet with people so misinformed and against dividend investing, it just gets my panties all bunched up and I'm just frustrated. Let's move on to claim number 2. Dividends are the exact same thing as selling shares because the stock price drops when you get that dividend. Okay, I'll be honest, yes, mechanically the outcome, the stock price adjusts on the ex-dividend date. So for instance, to make it super simple, let's say a stock is $100 a share and they pay $1 dividend for that payout. It'll open the market at $99 on that ex-dividend date to account for the dividend. But fun fact, friends and family, you can fact check me, 9 out of 10 times, that drop is usually erased quickly by market behavior and folks buying into the stock. And the stock in question, it'll be $100 or even $101 by the end of the day, and certainly by the end of the week. So this argument is, for a lack of better words, just ridiculous. Because if you look up any high-quality dividend-paying stock that just paid a dividend, you will see that their share price went up after the fact. The people that make this argument, they act as if the dividend reduces the stock price permanently and the company is now worth less, And given a matter of time, that stock price is going to go down to zero because of the distributions and the dividends. Actually, let's just take a look at some examples together. Now, in the month of March and April, there's been hundreds of publicly traded companies that have paid out a dividend. However, for our case and sake, let's take a look at Walmart. Jump on over to their dividends tab. They had an ex-dividend date on March the 20th for a 24-cent dividend, and the payout date was April 6th. That the stock price would have dropped by 24 cents on March the 20th. Now, let's take a look at what happened to Walmart since then. Jump back, I don't know, let's just do 3 months so we can take a look at it. So on March the 20th, on the ex-dividend date, the stock price did in fact drop. So it was roughly like 119. But friends and family, don't be a dirty, stinking liar. What has happened since then? Oh, what do you know? Walmart is now $126. So even though the stock price did go down temporarily, it didn't matter in the grand scheme of things, right? And that's just Walmart. Let's take a look at another one, Coca-Cola. So jump on over to their dividends tab. And by the way, the website that I'm using is stockanalysis.com. I do have a referral link in my description. It gives you a 10% discount on top of whatever promo they've got going on. So they had an ex-dividend date on March the 13th. And the payout date was April 1st, and it was 53 cents. So March the 13th, take a look at what happened. Leading up to the ex-dividend date, the stock price did in fact drop by a little bit, right? It went from roughly $77.63 down to $77.34. And now Coca-Cola is $77.47. It's pretty much flat, and we'll quickly do one last one with Target. Jump on over to their dividends tab. Ex-dividend date on February the 11th for $1.14 in dividends. So February the 11th, we'll zoom back 3 months, take a look at what happened. Leading up to the ex-dividend date, it did drop by a little bit, $115 down to roughly $114. But since then, friends and family, not only did you get the $1.14 in dividends, but the share price also went up, and now they're currently $121. So just because a dividend-paying stock pays a dividend, it does not mean the stock price is going to be suppressed permanently. It is only temporary, and for the most part, usually only lasts for a few hours, or worst case scenario, maybe up to a week, depending on the macro environment, but also what's happening in the market in general. If it's a market-wide sell-off like we saw in April 2025 or during the Iran crisis, of course, it might stay suppressed or even go down further into the red, but that's not because of the dividend. That's because hedge funds in big money, they're selling out of everything and hoarding cash, and so stocks are just going to go down in general. But hopefully you're starting to see that just because it pays a dividend does not mean the stock price will stay down forever. Now let's move on to claim number 3. Effectively, it's this. Dividends are just forced selling and with worse taxes. I don't get to plan on when to sell the stock when I want to. Instead, they force me to take the dividend regardless. First of all, you get the dividend distribution regardless of what the broader market is doing. It doesn't matter if the stock market is up, down, red, yellow, sideways, hairy, liberal, conservative, you're gonna get that dividend payout. And that psychological weight off of your tiny little shoulders, dude, that's a huge value add. And then number 2, fundamentally, a dividend is proof that a business is crushing it and a distribution of their cash profits from their pockets to the investors' pockets. So when you think about it that way, instead of saying, oh, they're forcing me to sell my position through this dividend, no. If a company has $5 of bottom line per share in the net income, so earnings, it's all the exact same thing as semantics. $5 of profits per share, and they give you $2 in dividends, you get a portion of the profits, and the business in question that you're invested into, they still have $3 to reinvest back into the operations. Calling that selling and it's forced and it's against my will is like saying a landlord collecting rent is selling part of the property. That makes absolutely no sense. So by investing into a dividend-paying business, you know right off the top of your head, for the most part, that they're profitable because they have enough cash on hand to give some back to you. They're predictable and they're shareholder friendly. Because when we talk about growth stocks, and I say that with skepticism, Because just because a business is labeled as a growth stock, it does not mean they're necessarily going to grow in their share price. And they'll be burning through cash and disregard the shareholders, do a crap ton of stock-based compensation, and not care whether or not you get anything out of investing into them. But with a dividend-paying business, you're going to be getting something out of it. You're going to be getting dividends plus the share price appreciation. So I don't know about you, but if I know that a company is flush in cash and they have excess amounts of it and no more of it going into R&D, marketing, or hiring more people will grow the business and have a positive ROI, I would rather see that money come back to me as an investor. Why? Because the whole idea of investing into equities, stocks, ETFs is to get an ROI, to see your $100 turn into $200 given an X amount of time, right? One way of getting that is through the dividends. Because if you're just going to bank on the whole idea of putting your $100 into a growth stock or ETF, that $100 may or may not turn into $200. It could very well go down to $50 if they're a dumpster fire and they're burning through cash and they're unprofitable. So just because something is a growth stock, it does not necessarily mean the share price will grow. And then the dividend tax argument, it always makes me want to do something as crazy as boarding a 14-hour flight from Japan to Seattle with my phone's battery at 1%. So I just have to raw dog the entire flight with a crying baby next to me. This is just a silly argument. Most dividends and distributions we dividend investors prioritize are going to be qualified dividend payouts or, best case scenario, return of capital, which means they're going to be taxed in an optimized manner. So if you sell a portion of your portfolio, believe it or not, you're going to be taxed at the capital gains rate. And so will the qualified dividends a dividend investor gets. So it's the exact same thing. Just because you're a dividend investor does not mean you go 100% into REITs that are taxed at the ordinary tax bracket level. Right? That's what these people are insinuating, and it just drives me up a wall. Better yet, you collect dividends in a Roth IRA account, and you're not going to be paying any taxes on the passive income that you get. So that argument goes right out the window. And right onto my neighbor's lawn, their dog poops all over the place. He never picks it up, so we just toss it right back on to their lawn. And the whole idea of like, oh, I don't want dividends because of the tax situation. Think about it like this. Who in their right mind is going to turn down a raise at work because they don't want to pay taxes on additional compensation? Like, get real with yourself and stop lying, right? Every single one of us will say yes, shake their hand, get on our knees and say thank you, and we'll happily pay more taxes on the additional income or bonus or raise, whatever you get at the end of the year. Stop lying. Now this next argument or claim number 4, even your DoorDash driver that delivers your Chipotle burrito at a very cold temperature because it took him 40 minutes because he did a detour to take a smoking break, he would even know the answer to this. And it's, there is no difference between a dividend and selling shares. Whenever I hear that, I'm not exaggerating. It makes me want to go skydiving with a freaking rock taped to my chest and with no chute. What kind of freaking argument is that? When you sell shares, you fundamentally reduce your ownership stake permanently. Okay, that means you miss out on any market bull runs, on rebounds, rallies, everything. You get less of everything. Whereas with dividend-paying investments, they pay you without reducing your ownership or share count. Friends and family, if you take away anything from this video, that distinction matters over decades, over time. For example, if you plan on doing FIRE in the traditional modality of selling 4% of your portfolio annually, eventually you run out of shares. Your 10,000 shares of whatever it is, VTI, VU, SPY, QQQ, will eventually turn into 4,000 shares and then 300 shares. And by the time you slip and fall in your shower as an elderly person, you'll have maybe 10 shares. And to me, that just sounds crazy. Because if you have friends and family or causes or organizations that you care about, you can't contribute anything from you to them when you croak. When it's done, it's done. It's gone, it's depleted. However, with dividend-paying investments, it goes from your hands down to your nephew, your daughter, your organization, charity, whatever it is in question. Think about it like this. Say you own real estate, physical properties that generate money. And let's say you have 4 properties in your portfolio. Would you rather sit back and collect rent from your rentals every single month, every single year? Or would you rather sell 1 property a year to make money and then eventually be down to 2 properties, 1 properties, and then have 0 properties? Right? It just makes no sense to me. Why would you want to do it that way? Let me show you a tangible example with QQQI. It's a NEOS ETF based on the NASDAQ 100. So let's go ahead and assume we have $500,000 invested into it. This is our retirement portfolio that yields us 10,000 shares, $51.94 a share. Dividend yield is 14%. Now, under the parameters of reinvesting the distributions, stock price going up by 5%, dividend growth rate essentially flat, after 10 years, the dividend income from that $500,000 would be $250,000 in distributions, and the portfolio would be $2.4 million. But this is not a video about what happens after 10 years. Let's not even reinvest the dividends. Let's scroll on down and take a look at the dividend income in year 1. It would be roughly $75,000 if we round up. $75,000 off of $500,000. And as we fast forward the years in our retirement, the dividend payout grows year over year. Eventually, 10 years down the road, the dividend payout will be $88,000, of which 95% at a minimum is going to be return of capital. Now, to get the same amount of dividends as year 1, if we were to apply the logic of the FIRE community saying we need to sell to get $75,000, we would need to essentially, out of our 10,000 shares of QQQI, we would need to get rid of 1,438 shares. Sell that amount, and you get roughly $75,000. If we were to do that, then what boils down to having 8,562 shares of QQQI. And look at how that drastically changes how much income you get in year 2. $64,000. You fast forward 10 years down the road, $75,000 in your dividends because you sold how much ownership you have in your shares of an ETF. And if we continue playing that game and reduce it down to 6,000 shares in year 3, the dividend payout will be $44,800 in year 3. You fast forward 10 years, and now the payout is $52,000. You apply that same logic more aggressively, and we boil it down to having 500 shares down the road. That payout for that year, $3,700 of dividends. So friends and family, with dividend investing, I don't have to sell my shares. So my 10,000 shares of QQQI, while not reinvesting the dividends, it has the opportunity to keep paying me while keeping it intact. 10,000 shares in retirement will still be 10,000 shares down the road. Even if I don't reinvest the dividends, I like what I see. $75,000 to $88,000 in year 10, and the portfolio's valuation, roughly $846,000 from $500,000 initial capital. And if you're still not convinced because you're as stubborn as a shopping cart that has a broken wheel, and every single time you try to turn right, it won't let you and it jams, I just want you to sit with this, digest it, reflect on it later when you're sitting on the toilet. The data shows us that most retail and amateur investors like you and I, we panic sell during downturns. We miss time withdrawals. Like we think we're selling it at an optimal time, but in fact, it wasn't the optimal time. Had we waited 3 more weeks, we could have sold it at an additional 10% gain, but we didn't do that. We overestimate our discipline, and we feel like we're going to be able to execute our game plan. But when the time comes, we start to falter, we start to modify, and we start to adjust, and now our investing thesis is out the window, and we don't know what the heck we're doing. So if you want human psychology to work in your favor, all I'm trying to say is with dividends, it reduces the need to sell. Your 10,000 shares of ETI in retirement will still be 10,000 shares of ETI. With dividends, it reduces the emotional turmoil and the pain with the decision-making process of when to sell, when to do this. Oh my gosh, honey, I don't think I can sell my portfolio right now because we're in a market downturn because of a Twitter tweet, because of this, because of a confrontation. With dividends, you receive cash flow automatically every month, like in the case of QQQI, or every quarter, like other dividend-paying stocks. And with dividends, you build income stream over time because of the dividend growth rate. But don't get me wrong, a poorly constructed dividend portfolio can absolutely underperform and be a tragic, terrible thing as well. Because if your holdings in your portfolio, if it's filled with yield traps, where the dividend yield is like 20%, payout ratio being 120%, or it's filled with weak businesses that have an economic moat that's non-existent, or their gross sales are eroding year after year, I don't want to be rude here. I don't want to step on your toes. I don't want to go over your house, sit on your couch, and let out a fudge bubble. But we're not playing the same game. We're not on the same team. I'm advocating for high-quality dividend compounders with cheese. All I'm trying to say is after getting burned a few times with yield traps, value traps, you start to recognize the patterns and you learn to avoid the junk, the cigar butts, rather stick with high-quality compounders. Now, I had that realization in 2020. Or better yet, for the 99% of the people that are watching this video, just lean on ETFs like SCHD to do the heavy lifting for you because they apply the principles of Warren Buffett in value investing and they do everything for you, right? That's not financial advice, but honestly, most people are better off with SCHD and chill. Seriously, their CAGR since inception is 13%. If that's all you care about, then you should know that it slightly outperforms SPY, the S&P 500. So there you have it, folks. On this channel, we focus on businesses that actually grow their top and bottom line, generate real cash, and reward shareholders over time. If that's the kind of investing you believe in, believe it or not, you're in the right place. So subscribe and make sure you follow my public portfolio series where I talk about my investing thesis for stocks. And you can see which ones I'm invested into. And I promise you that you'll learn a thing or two on every single episode. If not, I'll go over to your house and do an oil change for free. Jokes aside, I love you guys. Stay safe. Good luck in the stock market. And I will talk to you next time. Peace.